Hello and welcome, everyone. I'm Taylor Pankratz, and this is Behind the Breakaway. Together with my co-host, Jason Barber, this show takes you behind the scenes of leaving your captive broker-dealer firm and explores the world of RIA independence.
All opinions expressed on the podcast by the hosts and guests are solely their own opinions and do not reflect the opinion of Uptick Partners. This podcast is for educational purposes only and is not legal advice and should not be relied upon as a basis for any decisions.
Welcome back to the Behind the Breakaway podcast. Today we're going to talk about all things payout in the RIA world. There's a lot of confusion out there. There's a lot of kind of misinformation. Today we want to try to help clarify how this all works. And so we'll take it off with, so for you, Jason, here's the question. What is, you hear all the time, payout percentage, BIPs, platform fees, ticket charges, technology fees? Like, kind of talk about what are some of these things and ways that the typical roll-up RIA or custodian tries to make money.
Mm-hmm. Yeah, good question. So, this is it seems like a very confusing thing for a lot of people. For me too, oftentimes, because you hear, the payout percentage is this, or the platform fee is this, or the tech fee is this, or the ticket charges, et cetera. And then it's just really hard to kind of break it down into what am I actually getting paid? What percentage of whatever the client is paying in fees, what percentage of that is the custodian or the broker-dealer taking, and what percentage of that is coming to the advisor, or the advisor, the RIA business? How does this all work? And one of the things about Uptick Partners is that we want to make it super simple and super transparent. That's our goal, because it seems like everybody else is kind of taking the opposite approach, which is if we make it really confusing, then, but we make it sound really good.
Right.
We say, you get a 92% payout, okay, or whatever it may be. We make it sound really good, then you just won't ask questions about all these other ways that we make money. And so we just think that that's kind of nonsense, and that we just ultimately want to try to cut through the BS and try to just be very straightforward and simple with folks. So, I think that one thing that I want to start this conversation off with, that you and I listened to another podcast one time from another individual that I think really resonated with us, is this idea that whatever the business line that you're in, whatever channel you're in, whether you're in the IBD channel, whether you're in the RIA channel, whether you're in the even to some degree, possibly in some versions or some instances of the broker-dealer world, the reality of the situation is that when the dust settles and you look at it and you say, how much was my, as we like to coin the term, my triple net payout, that I actually, after I paid my custodian, I paid my broker-dealer, I paid my staff, I paid my rent, I paid all of my technology, I paid everything, what did it actually shake out to? And the podcast that we listened to, the guy came on there and said, look, you're going to make 60 to 70% triple net when it's all said and done. And I just think that there's been very few words of advice that I've heard over the last couple of years as we've been in this industry that were any more true than that. There's just, at the end of the day, it's just like, no matter what line you're in, it's very rare. Now, it's not impossible, but it's very rare that you're going to be outside of that range.
Right. So an instance where you might be lower is maybe you're at a captive broker-dealer. They pay you 30 or 40% payout on your revenue that you're generating, and maybe they have a bad quarter or a bad the business isn't as profitable and you don't get as much profitability bonus.
Mm-hmm.
And so maybe that year you're going to make 40% payout. That would be kind of the low end on the, if you're going to be below the 60 or 70%, it's going to be because something happened at your broker dealer and they're not doing as much profit sharing. And you might be over 70% if you're in the RAA channel and you run extremely lean.
Mm-hmm. Yeah.
Right.
Like you work from home.
You work from home. You don't have very much staff, if any.
Mm-hmm.
You can obviously make more money,
Mm-hmm.
but the reality is
It's going to be hard to grow that top number, though,
right.
if you're doing that, right? If you're running super lean, you may say, yeah, I've got, a $250,000 revenue business and I'm able to keep 85% or 80% because I just work from home. I don't have any staff, and so it only costs me 15% in terms of, technology and
the smaller books of business, smaller book of business that you are, the higher your payout can be in the RIA world.
Yeah.
As opposed to the smaller book of business in the broker dealer world, you probably are a lower payout.
Exactly.
Right.
Yeah, if you're a smaller book, exactly. You're going to be more like that 40% number, whereas in the broker-dealer world, you can get up to 60 or 70%. It's just you don't have a lot of control over that, and you're kind of in this it's depending on how the profitability of the firm is, for example. So it's maybe not as guaranteed. You kind of look at it as your payout in the broker-dealer world is going to be somewhere between 40 to, say, 65 or 70%. But it's not really in your control as much over, what that actually ends up being. Whereas when you start to move more towards that IBD/RIA space, that's where you kind of get into this. You're almost certainly going to be at 60 to 70%. If anything, it's going to be higher than that. Although I guess, the cool thing is that if it was less than 60 to 70%, it would be because you intentionally decided that you wanted to advertise a ton.
Or add a lot of staff to be able to scale.
Yeah. You said, hey, I'm going to add a bunch of staff and I'm going to scale my business. I'm trying to grow. What I'm doing is I'm trying to grow that top line revenue number by advertising and marketing and hiring people, et cetera. And it's not saying that it's right or wrong, but the cool thing about it is that if you decided to do that, it would be your decision to do that. Okay.
Right.
And all you're really doing if you do that is you're just reinvesting into your own business and your own brand that you now own 100% of. Right. And
Right.
so it's not much different than buying equities, right? You're basically okay, if I'm making $1 million of gross revenue, I could net 600,000, but instead I'm going to take 100,000 of that money and go market. And I'm going to invest $100,000 into my business. And why? Because I think that that 100,000 is going to make me $100,000 more revenue.
Well, typically money that you invest in your business is going to give you a better return than putting that money in the stock market.
Exactly. Yeah.
I mean, and it's a good way to diversify, of course.
Mm-hmm.
In some way, I mean, your business is a little bit tied to the stock market in terms of revenue, but I want to draw attention to the fact that let's talk a little bit about people you hear all the time, oh, I'm going to go independent, I'm going to make so much more money.
Mm-hmm.
And that seems like a fallacy.
Yeah.
But it also seems like, at least when we were at our previous firm, you would hear all the time, oh, you go independent, you're only going to make 8 or 9 bips more, 8 or 9% more. I don't remember how they would say it, but I remember somebody coming to a regional thing and they were like, it's incremental how much more money you can make in the IBD channel. So you shouldn't even go.
Mm-hmm.
And I think people understand that that's not the very first reason why you would do it.
Mm-hmm.
You would do it for other reasons, and the byproduct of that would be you make more money more consistently because you're not beholden to what the overall firm does from a profitability perspective. Take 2008 or any of these years where the market doesn't do very well. odds are they're not distributing a whole bunch of profit sharing those years.
hmm
And so,
Or the firm is spending money on things that you might morally disagree with.
or just not want to spend money on
Yeah.
because you'd rather them
Yeah.
give you a dividend. right?
Exactly.
It's like,
Yeah. You just don't have control over how that money is spent, and you don't have as much control over the profitability and as you do your own individual business.
right, it's more consistent.
Yeah.
When you're in the RIA world, it's more, your revenue can be more consistent because you control it. And what is nice is that, yeah, you might make incrementally more money. The the smaller to medium sized books of business might make a pretty good amount more in the RIA world, maybe 10 to 15% more. But the top people at these captive broker dealer firms are making a pretty good amount when profit sharing is up.
Mm-hmm.
Right? They're in the 65 to 70%
Mm-hmm.
triple net, and that's hard to like.
The main thing is don't get caught up in this idea that, oh, you're going to go and now you're going to get a 90% payout, and somehow you think that, oh, wow, so I'm going to make 20% more.
Right.
The reality is that you're really not.
Yeah, the reality is that 90% or 92% or 95%, whatever the pitch is, almost 100% of the time, that comes with these caveats of, oh, well, there's a technology monthly fee that you've got to pay. There's a platform fee that if you want your clients to be fee-based clients or in the fee accounts, there's a platform fee that's associated with that. And what's so interesting is when you're doing the due diligence with these firms, you don't really have your book of business dialed in terms of, hey, how much of my business is this, and this, because you can't map your book. At our previous firm, you couldn't map your book.
Mm-hmm.
There was no way to be able to see what are all the holdings across all of your book and these types of things. And so when you're going to do the due diligence with these other custodians and other firms, that's what they want. Right? They want you to map your book and then give them an Excel spreadsheet that's got everything lined out, because what mutual funds that you own will dictate how much money that custodian is going to make on your book of business. Right? And so if you own a bunch of ETFs versus a bunch of mutual funds, the pro forma that they're going to give you is going to be wildly different. And so they're going to sit here and go, we'll pay you this much money, we'll pay you that much money, or we won't charge you as much ticket charges, etc. These custodians, nothing is written in stone until you've actually moved the book over, because you don't know. You can't map your book, so they don't know how much revenue they should be expecting off of your book of business, because it might be 90% ETFs, it might be 90% mutual funds, somewhere in between, and the actual types of mutual funds, not just if
share
they're
class. What share class? Yeah,
share classes, the actual holdings. Sometimes, like, will that even transfer? I mean, there's a lot of things that you can't do to be able to map your book, to be able to give these custodians insight into how much they should be expecting to make off your book. And I say all that because what ends up happening is you break away and you go to an IBD, and turns out that you actually take a pay cut, because what you didn't realize is that somewhere in the fine print, and you see it all the time, somewhere in the fine print, there's a 25 basis platform fee if they want to be fee-based. Well,
which is crazy.
It's
and so
crazy.
they're like, oh yeah, it's a 20 strategy fee, a platform fee, whatever you want to call it, some type of platform fee, and then you make 92% payout. So you're sitting here and you're like, okay, so let me think about this. I'm going to charge the client, just for easy math, the client's going to pay 1%, but then they're going to charge me 25 basis points. So now I'm only getting 75 basis points of the 1%. And then I'm going to get 92% payout on that 75, right? So whatever that equals out to, call it 70 or 65. And so now you're sitting here and you're like, well, I'm at 70%, payout. I got 70 basis points out of the client's paying 100 basis points. I got 70 after, even though I'm a 92% payout, right? So you're sitting here and you're like, wait a second, how am I at 70? And then I still got to pay my staff, and I still got to pay my rent, and I still got to pay all these things. And so then you end up and you kind of find yourself in this like, whoa, what in the world? I'm at, I thought I was at a 92% payout, and triple net, I'm at 55,
Right.
and I was at 65.
Right. And you took
Or
a
70.
pay cut.
You take a pay cut to go IBD, which is like, in what universe does anybody think that's going to happen?
Right.
Okay. But you can
Right.
see how if you're not very clear, if you just looked at the headline and you said 92% payout, you would think this is this is, so it's important to.
Well, it's very important, and it's important because it's just there's a lot of uncertainty and gray area when you're getting pitched these pro formas
Mm-hmm.
from these IBDs because it's garbage in, garbage out. You
Mhm.
don't know
Mm-hmm.
how many people are going to come with you, how many people are going to be fee based when they do,
Mm-hmm.
right? And there's a different cost. For some reason, there's a different cost to if they're in a fee based account or in a brokerage account,
Mm-hmm.
or if they're want to have a TAMP, right? We should talk
Mhm.
about TAMPs.
Mm-hmm.
If they want to be in model, if you want them to be in models, there's this whole other cost to that. And so you start to go, well, I want to pull all these levers to make my business more efficient, and all of a sudden I made it way more efficient, but I got
A pay cut.
a huge pay cut.
Mm-hmm.
And you're just like, it doesn't need to be that way. But unfortunately, that happens all the time because people just you don't know
Mm-hmm.
the breakdown of your book because you can't just go and print that off,
Mm-hmm.
right, at
Yeah.
your captive firm, or else that's going to raise a lot of red flags.
Mm-hmm.
So you're having to kind of do a lot of estimating.
Mm-hmm.
And
And of course, the salesperson from the IBD is going to tell you whatever they need to tell you to try to close the deal.
right, when you find out when the rubber meets the road, it's too late.
Exactly.
You've already
You can't undo it.
right.
You can't undo
What
it.
are you
going
gonna
to
do?
You're not going to repaper your book,
No.
all right? And so now you're stuck, truly. And so it's kind of like goes back to the whole "don't move your book twice" thing. It's like you either A, can't, or B, don't want to move your book twice. And the custodian and the broker dealers and the independent broker dealers, they know that. So they know that at the end of the day, if they can get you there, that you're a prisoner, for lack of a better term, And a lot of times they've given you some upfront money, incentive, forgivable loans, whatever else, right? So that you kind of are in this position of you're stuck.
Yeah,
And-
they what they do is they arrange it to where it actually costs the client or you, however you want to look at it, you're either increasing the client's fee to cover this cost or you're paying for it on the things that make your business more efficient.
Mhm.
So you obviously want to put people into fee-based
Mhm.
or put them into models or any of these things so that you can scale. They know you're going to want to do that. That's one of the whole reasons why you're leaving your captive broker dealer to do that.
Mhm.
So what are they going to do? They're going to align their economics to where
Mhm.
they make more money when you do that.
Mhm. Yeah.
And it's just unfortunately, that's just how it works,
Mhm.
right? That's just how it works. So in the RIA world, we're trying to shine a light and bring some transparency to this whole thing because it
Mhm.
doesn't need to be this complicated.
Exactly.
It just doesn't. But the problem is when you go out there and you're shopping payouts, you can't possibly know what your payout is going to be at these different IBDs and different RIA roll-ups because they all have different terminology,
Mm-hmm.
right? It's not like it is in the bond world where you're like, oh, yield to maturity is yield to maturity, whether it's a 30-year bond or a 6-month. It's like
Mm-hmm.
you've all got the same. They don't do it like that. It's
Mhm.
all about, well, this is your payout, and then this is your platform fee, and this is your technology fee. And you have to kind of be here to figure it out, and then it's too late.
Yeah. Ticket charges,
Ticket
some
charges.
people have ticket charges. Some mutual funds have them, some don't. Some stocks have them. Some places charge them on stocks. Even though in what universe should you pay ticket charges on stocks? Who knows? But but that exists, and so yeah. So I mean, ultimately, our vision, and the way you can think about it in the RIA space, and specifically with Uptick Partners, is to make it more transparent, more simple, easy to understand. And the way we see that is that, look, at the end of the day, you're starting at 100% payout, right? Like, there is no big broker dealer, big custodian that is going to be taking a piece of your revenue right off the top. Okay, there's no big corporation that you're dealing with here. So it's here's my revenue. Okay, I have 100% revenue. I have an expense associated with technology, expense associated with operations, with HR, with putting the whole platform together, with the transition, et cetera, right? Everything that goes into that, it's a business cost of X basis points, right, to operate, and then that's it, right? That's what the cost is. That's and what we anticipate is that what that does is by keeping it really, really simple, and you say, hey, here's my revenue, here's my operational costs, minus then outside of that, I've got to pay, say rent and staff, okay? And then I can figure out, here's what my triple net number is. We think that for most advisors, they're going to find that triple net is going to end up being closer to 70%, okay? Closer to that. It'll depend, again, on the size of a person's business and kind of what their business looks like and things of that sort. But that's the vision, ultimately.
The vision should be that Uptick Partners is going to get you the most competitive payout that exists in the RIA world.
Mm-hmm.
And why is that? Well, because what we aim to do is particularly for the breakaway advisor from the captive broker-dealer space, give them and provide them the things that they have to have, want to have, but nothing that they don't.
Mm-hmm.
Right? So we want to provide best-in-class compliance and technology, an investment platform, and human resources, and marketing, and do these things at a very, very high level, but not charge people to have a on-call CFO, right?
Yeah.
Or in an alternative investment team with 15 people on it that are researching private equity deals 24/7, right? We have access to the alts market, right? And I would encourage people to, that is a huge asset gathering tool, is the alternative investment space, and we'll talk about that. But you don't need to pay somebody to be on staff that is the expert alts person to put in front of a client at a moment's notice.
Or if you feel the need, then just hire your own, right? I mean, that would be the idea, is that it's like we should look at that as that's an example of something that is if anything, it's a want, not a need. Okay. And so not everybody is going to want that, though. And so we want to basically,
so you shouldn't have to pay for it.
You shouldn't have to pay for it. Okay. And so some people are going to want vanilla, and vanilla costs less. Okay. So at the end of the day, that's the vision of Uptick Partners, is to be able to give you the ability to control your costs, keep your costs as low as possible, and then be able to be an entrepreneur and say, hey, what are the things that you want to customize your own business with? Maybe you want to have your own podcast studio and you want to be able to invest money in those types of things. Well, guess what? If you want to do that, your payout might be a little bit less because you're intentionally deciding that you want to focus more of your resources on marketing in a digital fashion, for example.
Or you want to leverage our CPA practice.
Yeah.
Right?
Yeah.
We shouldn't be charging every advisor to utilize our CPA staff, but we should charge them if they want to.
Exactly.
And that's what we intend to do, is not we don't intend to charge people for things that was one of our biggest hangups with the other IBD channel and the RA roll up was that you were being charged for things that maybe you needed very, very sparingly
Mm-hmm.
or if ever. But you're being charged as if you're using that person every day. Kind
Mm-hmm.
of like a retainer for a lawyer.
Mm-hmm.
And you're kind of like, I just don't know if we should be paying that year in and year out.
Mm-hmm.
And so that's why we can comfortably and confidently say we expect your payout with Uptick Partners will be higher, will be the same or higher, should be higher than what a competing firm is offering you
Mm-hmm.
because we want to deliver you. We should. Oh, I forgot to mention cybersecurity is another thing.
Mm-hmm. Yeah.
We want to deliver you top-notch service, but just the things you want.
Mm-hmm.
And so a lot of these other large
Or things
IBDs
that no, it's things you need, things that
Yeah,
you
sorry, things you
absolutely,
need.
things you need, things that you're just like, look, you have to have a robust cybersecurity platform. It's a must have. You can't go through an SEC audit and not have a good firewall at your
Yeah,
office.
there's certain things you
right?
don't want to skimp on.
Yeah, you just don't want to skip on that. You can't not have a compliance program, and you can't not have good technology. Technology, but that doesn't mean that you need to have your own personal IT person on staff necessarily full time, right? Like
Right.
you may not, or if you do, maybe that's because that's what you want personally, okay? But we're going to do the things that you have to have. We're going to do them really well, okay? The things that you have to have, and then what the result of that is going to be is that your costs are going to be low or lower than they would be in your payout. Your triple net payout is going to be higher or potentially higher than what you could find anywhere else.
Well, and I think if you ran the numbers for a normal size business, that the payout is going to be actually higher than if they did it themselves,
Mm-hmm.
because what you get in this fintech world is economies of scale,
Mm-hmm.
of course.
Yeah.
And so you don't have to have, the same cost that it's going to take one advisor to have cybersecurity.
Mm-hmm.
That cost gets spread out a lot more efficiently against 5 or 10 advisors than
Yeah.
because there's not much more server space you need to add
Mhm.
more advisors, right? You've already
Yeah.
paid for a rack.
Mhm.
So these are the things that you're going to have to buy, whether you're doing it for yourself or whether you're rolling into a roll up like Uptick Partners. So I would say that if you did it yourself, I would venture to say your payout could be less than what it will be at Uptick Partners because you're not getting those things at scale like
Mhm.
the technology stack.
Mhm.
You're gonna have to get a subscription, your own subscription to all these technologies
Mhm.
versus plugging into ours and we've already have the subscription,
Mhm. Yeah.
right? And so I think things like that, it would be interesting to see, but I can guarantee you there wouldn't be a lot of light between the payout
Exactly.
for somebody that's doing it themselves, an RA by themselves, and starting that up
Yeah.
and plugging into
And that's our
ours.
goal, right? I mean, our goal, and that's one thing that I'm sure we'll talk about. And folks that are listening and listen to a lot of our episodes, you'll hear us talk about a lot. Is that our mission, our fundamental value, our core values of what we're doing here is to look at this as an opportunity for us to help breakaway advisors from captive broker dealers break away to true RIA independence, fee only RIA independence, deliver a platform that is robust and has everything that they need for a good price, a very competitive price, deliver more value than what we're charging in fees, which is what we try to do for our clients every day as well. But at the same time, know that our mission and what's imperative for us is that we have to be delivering more value to you than what you're paying, okay? Than what you're paying Uptick Partners, and so at the end of the day, if we fail in that way and you decide and you join Uptick Partners and you decide at some point in time in the future that you want to go and run your own RIA and you want to not be plugged in to Uptick Partners, that we're not going to stand in your way, right? We're not going to make that difficult for you. We're not going to sue you. We're not going to do any of that kind of stuff, because our job is to make it economically make sense. Okay. That at the end of the day, you might look at it and you might say, hey, I could go do my own RIA and have my own ADV, which, by the way, you wouldn't have to repaper your clients. Okay. You wouldn't have to repaper them. Your clients are already in the RIA space. You'd probably have to, develop your own compliance program, develop your own cybersecurity program, figure out your own technology, all the things that we're going to do. You would have to go do that on your own. And you would basically look at the economics of that. And more than likely, what we suspect is that there's not going to be a huge financial savings for you to go do it yourself. Okay. There might be some, but it isn't going to be, I think you said there's not going to be a lot of light there, right, between those two numbers. And that's what we're ultimately building this business on, right? Is this idea that it makes sense for you to want to just roll up underneath us and gain economies of scale, and that it's not going to be a whole lot. It's not going to necessarily make a lot of economic sense for you to run your own RIA. However, if you choose to do that, then you're free to do it, right?
You own your own book of business. You'll brand. You create your own brand. Whatever, John Smith Wealth Management, and we help you create a website. We help you create that brand, launch that brand, build your brand equity. But to Jason's point, if you want to go and step out and do the RIA by yourself, you're more than free to do that. I can just say, I legitimately believe it's going to actually cost you more money to do that than it is to plug in. If you utilize the things that we've got in place, like, let's just say an example would be our TAMP, right? So why don't you talk a little bit about what the TAMP is, Jason, and the economies of scale that gives us? Because what you're going to find out is if you kind of want to run your clients' assets and invest the client's assets in a way that was similar to your captive broker-dealer firm, where you had kind of an investment team that was doing these things and making those trades and raising cash when the client needed cash, and kind of outsourcing the investment management to the powers that be at the home office. That's something that in the RA world historically costs a lot of money to replicate, right? And what we've done is with the economies of scale, we keep saying that word, we've brought that cost down to a fraction of what it would cost you to go and replicate that yourself. So I legitimately believe that if you tried to roll out a lot of the things and services that we want to provide the people that join Uptick and the advisors that join Uptick, be able to leverage that to their clients, that it's going to actually cost you more money. We're not even, well, Jason will talk about the TAMP, but we should also talk about the CPA practice, right? And utilizing our staff of CPAs in an ad hoc or leasing their time perspective, instead of you having to have a CPA on staff and paying them and kind of
training them.
And so I legitimately believe that as you leverage more and more of the services that your clients are going to come to expect and you're going to want, that it's going to end up costing you less money just to use the platform that Uptick is providing because of our scale. But talk a little bit about the TAMP and what that could look like for people.
Yeah. So I think the first thing we want to talk about is, what is a TAMP? So TAMP stands for Turnkey Asset Management Program.
Platform.
Yeah. Turnkey Asset Management Program, I think is what the P stands for. So basically, think of this as kind of like an optional solution or service that you'll have the option of taking advantage of with Uptick Partners. And for all intents and purposes, what this is it's basically hiring a third-party registered investment advisor, RIA. Okay, you're hiring a third-party RIA to do all of the trading and asset management associated with your clients' portfolios. Okay, and so you're basically sharing discretion. Maybe would be the way to look at it. So if you don't want to actually have to go and put in the trades and do the rebalancing of people's portfolios and invest money. Hey, this person's putting in $500 a month into their portfolio. How do I make sure that that money gets invested every month? Or maybe you want to be able to subscribe to a variety of third-party models. You say, hey, I really want to have fidelity models in my, that my clients' monies get managed in, or a Zacks model, or American Funds model, or whatever the third-party money manager is. You can use a TAMP, okay, for that service. You can basically assign, or you can kind of use like what's called a UMA type structure, where you can have multiple money managers as part of one particular account, for example. So you could say, hey, I want to have Fidelity manage half of this person's account, and I want American Funds to manage the other half of this person's account. And you can basically just assign an account, one client's account, to this particular UMA strategy that you have created. And then you're hiring the TAMP to do all of the trading. And if a client needs money, client needs $10,000, you go in and you just request that this $10,000 be raised. And you can put all kinds of restrictions in there if you want, and say, hey, I'm trying to keep the capital gains below this much. I'm trying to, I don't want you to sell any of this, or what have you. So you can put kind of some restrictions on there. But the main thing about it is that it's as the name suggests, it's a more turnkey solution when it comes to asset management. And there is a cost associated with using the TAMP, which is why it's so nice in that it's an optional service. You don't have to use it. You can use it on some clients, and some that you use it none. And some of it just depends on kind of how you want to run your business. There were some advisors that were very what they called APM, I think is the terminology that you might hear people use. I think that stands for advisor as portfolio manager. So there were types of accounts where the advisor, again, without discretion, of course, but the advisor was basically going in and making any kind of changes. And then there were some types of accounts that were more of like kind of like a model, but the advisor was sort of deciding the model, right? And that's still sort of like an advisor as portfolio manager type structure. And then there were, of course, the types of accounts where it was more outsourced, and the home office was making, the home office had discretion over what funds or what ETFs were in that particular portfolio. And so ultimately the TAMP is most closely in alignment with what you would expect in that third option, where the home office has discretion. In this case, you're kind of sharing discretion with a third-party RIA, right?
Which isn't us.
This is yeah, exactly.
It's not up. It's not up. It's not Uptick. It's not the other firm.
Exactly. Yeah, exactly. So it's a third party, right? Who's going in and placing trades
and specializes in investments.
That's right. Exactly.
Right? That's what they do. That's their business, right?
Exactly.
Is they do this for a whole lot of other firms that want a outsourced CIO type of thing.
Mm-hmm. Yeah, exactly. And they've got credentials, CFA credentials, et cetera, so that they're running models and things of that sort.
So you don't have to use it, but what it does is if you want to use it, it adds some efficiency and some scale and gets you.
And from a cost standpoint, like we talked about, I mean, we saw an RIA that was recruiting another advisor and looked at their ADV, and I think the cost for that particular TAMP was somewhere around 50 basis points, if I'm not mistaken, 0.5%.
Right.
That either the client is paying or you're paying. Presumably the client is paying.
Right.
And which is, 5 times as much as our TAMP costs.
Right. So our TAMP will be 10 basis points. And again, the client pays that. I guess the advisor, if they want to, can pay that. But that's in line with a lot of the captive broker-dealer, outsourced options, is that 9 or 10 basis points. And we feel like that's competitive. And what's great is that you can, so you have the option. You can either use it or not. If you're used to using it at your current firm, maybe you use it here and it's not going to be this big shock price increase or fee increase that your clients are going to experience, which is going to be nice. Or if you decide, actually, I don't want to do that, the RIA world, you'll have discretion in the fee-only RIA, and so you can have your
own models.
You can have your own models, and you can do your own, trade out of things across your entire book. You can do it that way too. So you'll have some efficiencies even if you don't do the outsourced, do the TAMP option. But the TAMP option is definitely kind of the easy button, the easy button for sure. But the RA world does give you that option of trading across the book.
But how nice is it too that our TAMP is integrated in our technology?
Right. That's
Right?
something that's,
I mean,
like, you would think that would like be
it doesn't
standard,
exist,
but it doesn't exist.
It doesn't exist. And so, typically you've got to go to a whole nother thing if you want to go access the TAMP. And we just thought that was nuts. That was crazy. So
Yeah.
So we're really proud of what we've
We're
got
very
there.
proud of our technology stack. I would say I would put our technology stack up against any other RIA or IBD firm out there in terms of its integration with the latest and greatest technology. Because a lot of times what you'll see as you explore the space, you'll see a lot of technologies that say they integrate, and you'll do a demo, right? And it'll be using dead data that's not live. It's not actual live data. And so they've kind of put the pieces together to make it look like it works seamlessly. And then you do what we did and you sign up for a long-term contract and you realize, actually, this is not good. This isn't integrated like we were told, like we thought. You ended up having to spend 6 figures of a cost to get out of a contract. That's how bad the technology can be, that you actually spend 6 figures of money to get out of something. Right? So the technology, so don't make that mistake. And and we've seen a lot of the technology at the IBD channel, and it's a lot of it is just antiquated,
Ugly.
and ugly, and looks like it was built in 1995. And the problem with a lot of these larger firms is it takes too much time for them to integrate the cutting edge technology. By the time they integrate it, it's already old, and they've got to try to start this next project of integrating new technology. So what's nice about the tech stack that we've built is it truly does use the latest and greatest technology that exists, and it's integrated in a way that you don't have to live in 5 or 6 different screens every day to use to work, right? You can live in one ecosystem and do 90% of what you need to do every day in that one,
which is made custom for you. Right,
exactly,
right?
Exactly.
Made custom for you, your brand, your own mobile app.
Yeah.
Okay.
Your clients will download a mobile app that's got your brand. It's John Smith Wealth Management app, right? It's whatever you want it to be. It's your brand. And so your clients and everything your clients will utilize on the app is going to be white labeled for you, which is, it goes a tremendous way in legitimacy of what you're doing from the client's perspective. You just had a phone call with them. They just trusted you to that what you're doing is legit, that they're moving their accounts to you, and then you're going to tell them, well, okay, well, download my app. That's going to go a long way.
Yeah.
Versus, well, download the XYZ app. And they go to the app store and it's got horrible ratings, and it's like, oh, this is not a good start.
Exactly.
Right? And it looks terrible. I mean, this is what we are striving for you to the feeling for your clients is that this is an upgrade, that this is a good thing for them, that this is a positive thing for them, because that's what you're going to be telling them. And so they need to they need to hear it from you, and then they need to feel it,
Mm-hmm.
right? Because people, what they say, they don't remember what you said, but they remember how they felt.
Mm-hmm.
And so that's what's so critical about the whole thing ties together into one cohesive feeling for your client that when you tell them you broke away and they Google your name and it's crickets, right? Or
Mhm.
you're still at your old firm and they can't find your website of your new firm,
Mm-hmm. That's a
that's a
problem.
problem.
Yeah.
Right? That's a problem.
Mm-hmm.
That's a problem. And it doesn't mean that the clients aren't going to move with you. It just means that that the the hesitation of them going, maybe I just won't be the first one
Mm-hmm.
off the boat,
Mm-hmm.
right? I'm just going to kind of pause a little bit, and he'll call me back,
Mm-hmm.
and they don't realize you can't call him again.
Mm-hmm.
And so there's a tremendous amount of time and effort and thought that has gone into the entire platform and making sure that it's boutique and it's specific for the breakaway advisor from the captive broker dealer firm that gets one phone call, that is used to technology, that is integrated, that lives in one ecosystem the majority
Mhm.
of the time, that the staff it's easy for the staff to use and to do business,
Mm-hmm.
that it all works together seamlessly, that your clients have a good experience with the technology. I mean, all of these things go into building your brand.
And it doesn't happen accidentally. No.
It's a tremendous lift that we know because we have sat here and had to apologize to clients for months
Mm-hmm.
when we had the old technology and not what we're using today, but the old technology that, oh, my annuity's not showing up in the
Mm-hmm.
on the platform, and it looks like my account balance is. I mean, when you've got hundreds of clients calling because their annuity doesn't show up on their statement or on their client
Mm-hmm.
view, and they look like they've lost 100 grand, and it's really just the annuity just isn't there. That's a conversation
You don't want to
that
have.
you don't want to have to have. It's a simple thing, right?
Mm-hmm.
Oh, the annuity's not linking. But when you have to have it multiple times a day and your staff's having to have it, your staff has better things to do. You have
Mm-hmm.
better things to do.
Mm-hmm.
And it's your client's going to understand, but also it's like this little,
It's a crack in the foundation.
it's a little bit of a
Yeah.
crack in the foundation of, I don't know if this was a good idea,
Mm-hmm. Yeah.
right? You want the least amount of those
Yeah.
that are possible. You're never going to have none.
Mm-hmm.
That's not realistic. But
Mm-hmm.
what we want to help you do is have the least amount possible
Mm-hmm.
so that you have the best chance of success. And then once you've transitioned those people, they're your greatest advocates, right, for
Mhm.
getting new business. And and then the whole idea of getting new business and actually growing, having a platform that you can go out and offer clients alternative investments
Mhm.
that tie in and feed into their client portal so
Exactly.
that they want to go put money in
How cool is that?
XYZ fund, that shows up.
Yeah.
And it's not this outside thing they're having to be like, oh, remember I have that
Mhm.
100 grand out there. It's like, no, it shows up
Mhm.
and it's integrated.
Yeah.
So, like you said, Jason, these aren't things that just like you should not take that for granted that should happen.
Yeah.
That does happen.
Yeah.
Even though it's 2024,
Yeah.
you're like, of course it happens.
Uh-uh.
No.
No, it
No.
is definitely not there is, yeah. I mean, you cannot just say, oh, yeah, like this is the mistake that we made is that I legitimately, thought, hey, we're going to break away and I'm going to come over here to my new office and I'm going to be able to log into this technology and, like it's just going to work, right? Like because you spend 6 figures of money having the best technology that and you just think it should just work. Okay. And the reality is that we had to learn that lesson the hard way, that things like that, they don't just happen. You've got to have, you're either going to spend a tremendous amount of effort figuring it out for yourself, right? Figuring out the lessons that we figured out and the things that we learned, or you're going to let us help you and it's going to be way, way better than trying to figure that out on your own.
Yeah.
but you're going to basically be the closest that you could possibly be to being that fully independent option. And you'll know that you can always make that leap later if you want to, all right, with minimal effort, but not have somebody who's going to try to stop you, right, for lack of a better term, because we know the challenge and we know that economically we're going to be offering something that's compelling, right, which is the whole idea. The whole idea is that you should want to be in a place where it's so good that you wouldn't be crazy to leave, but you're free to leave whenever you want. I oftentimes think about, the Big 12 football conference and the Southeastern Conference in college football, and how the SEC has no buyout at all, right? You can leave literally whenever you want to, okay? Whereas you leave the Big 12, and it's like, oh, that's going to cost you $50 million a year if you want to leave early, okay? Why? Because they have to have these penalties, because of course you would want to leave. Right? Of course you would, if you could just leave, right? Whereas the SEC is like, you would be dumb to do that, okay? Right. And that's ultimately what we're trying to create. We're trying to basically be the SEC of the RIA aggregation business, where it's like we make it so good that, sure, you're welcome to leave whenever you want. It's just you're probably not going to, because it's like we're not going to stand in your way. We'll help you, to some extent if you want to, but we're just willing to bet that it's not going to make economic sense for you to do it on your own.
Right.
So, I know it's a random, subject, but one thing that came to my mind was the idea of the Pantera 401k tool and how cool that is.
Yeah.
So I know we're kind of it's a podcast. We're just kind of flowing, and talking about different things. But I just think that is another example of a technology tool that's out there that, some broker dealers maybe and some RIAs maybe give you access to, and maybe, some don't. But has really just proven to be a very cool, very useful asset gathering tool for us. I think in the first, I don't know how many months we've been really actively using it, maybe 3 to 6 months, something like that we've really been using it. And I think we've already got maybe $5 million of new assets from that. And that's not even really, like, we haven't even really tried all that hard because we've been busy doing a lot of other things. But but the thing is that it is a extremely cool tool that clients love and appreciate. And it allows you to bring in new assets, and clients love it and benefit. So,
well, what is it?
Yeah. So basically, what it is it's a software that allows us to be able to directly manage clients' 401ks and 403bs that are held at outside custodians. So, for example, when we were previously at Edward Jones, if somebody had a 401k account at Fidelity, for example, technically, per the letter of the law, I'm not even allowed to advise them at all over how they should invest those dollars, right? I'm pretty sure that that's a fireable offense. I'm still not quite sure exactly why, but that's a big no-no, I know, is advising people about how to invest their 401k money. You're able to offer education, but you're not able to actually advise them about what they should do. So Pantera takes that to a whole, like the entire opposite end of that spectrum, where now a client can log in to Pantera. We can send them an invitation. Client logs in either on their own or potentially with you sitting there with them, logs in. They give us permission using this tool. And then what that does is it allows us through the Pantera portal to be able to go in there and actually make changes to the client's investments on their behalf with like turnkey, without the client having to approve it or log in or anything like that. It allows us to be able to manage their retirement account, manage their 401k account, and make changes to the allocations dynamically with our own discretion and manage those accounts. And then it also allows us to be paid for that as well. And so, the one, minor inconvenience is that you're not able to draft those fees directly out of the 401k plan. but you could take it out of alternative accounts that you're managing for them and just have it be part of their overall service. But what's also really great that I think is maybe even a little bit of an overlooked thing is how using this Pontera tool, a person's 401k plan comes into their software, into their portfolio management tool where the client they log into our mobile app, they see all of their accounts there, they see their 401k plan there, they see the performance associated with it, they see the risk profile associated with it. Everything is all like it might as well just be another account that you're managing for them. Okay. Whereas previously at our last broker dealer, there'd be ways that you could maybe either like add it as an outside account, but if you add it as an outside account, it's certainly not going to do any kind of performance reporting, right? And tell you, hey, here's what here's
The
how your
link would
401
always break.
The link would break if you linked it up. It wouldn't show you how it's actually invested. It wouldn't give you an idea of what the actual risk profile was.
Right.
Whereas now you can really truly show somebody holistically, hey, look, here's your overall risk profile. Here's how your 401k money is invested. You're driving 60 miles an hour on this account. You're driving 40 miles an hour on this account, and see how the overall assets are invested and what your overall rate of return is, your overall risk level, et cetera. And that's what people really want. And they're willing to pay for that, but prior to us being able to break away, we weren't able to offer that as a solution. And so now we are, and that's just another one of those things that, again, just day one, for the next advisor, knowing that, hey, we've already got that. It's already set up. You can take advantage of that literally from day one. So when you're calling your clients, you can, once they decide, hey, they want to come, you can immediately start managing that 401k money, okay, and start being paid for that. And that is really, like, clients love that.
Right.
Clients love that. And so why don't you talk, Taylor, about our vision for the CPA business, and then maybe we'll kind of call it a day after that. So
Yeah, so the idea that investments and this tax planning is intertwined, I think is not going to be news to anybody listening on this podcast. I mean, every advisor knows that the advisor can make the biggest impact in saving the client money and taxes by the things that they're doing, as opposed to what the CPA does at the end of the year or in April. And so what we're doing is we're creating this kind of bolt-on side of the business, which is called Holistic Tax Solutions, which is a CPA practice run by an actual CPA, and we plan on building that out for our clients to be able to leverage and have our clients get tax advice throughout the year, and then do their actual tax return and tax prep in-house, so the client's not having to utilize an outside CPA and be the quarterback and kind of be the middleman between us and the CPA. So that's something that our clients are, they're loving. We're pitching them on this idea. They're saying, sign me up. How do I sign up? Can you do it this year? Type of conversation. And so that's something that we intend to leverage and let other advisors that join Uptick utilize our pool of CPAs for their own clients, so that they can offer that service, that tax prep, tax advice throughout the year, that whole service that clients are wanting and willing to pay for, and like there's a huge need there. Instead of them having to go out and hire their own CPA or buy a CPA practice or put a CPA on staff and try to train them up and give them stuff to do in the meantime while they get a book of business big enough to actually pay for this person's salary. Instead, just leverage our pool of CPAs that we've got and say, hey, look, I'm going to pitch this to my clients. And then when you have a client say yes, guess what? They have a dedicated CPA that is now their CPA. And you can do that. You can scale that to as many clients as you want. And as they accept that, and as you get more traction with that, you like you don't have to worry about, well, when do I hire another CPA? Let us worry about that, right? Because we've got you and all these other firms that are leveraging our pool of CPAs, and so that you don't have these ancillary businesses, these other partner firms that are having to have all this staff, the CPA staff. Let us do that, and then you just lease their time, right? And that's a way that you can offer a tremendous level of of service and value add to your clients, but not have to figure out how am I growing this business, the CPA business.
Mm-hmm.
Just offer it as you would anything else, and if they want you to do it, that's great, right? That's great, and then just let us know, and we have CPAs that are ready for you to leverage and take advantage of what they're offering. So that's something that, I think maybe there's probably a few RAs out there. There's definitely no IBDs that do this, but there's probably a few RAs out there that that would do this. I don't know any off the top of my head.
But not the part where you can join them and take advantage of it. Right?
No, a lot of the firms, you know what a lot of the firms do? They give you access to their CPAs for your personal tax return as the advisor. Like a value add to the advisors.
Yeah.
Our in-house CPA will do your taxes.
Yeah, but we could do that too,
But I don't know if there's any firms out there that kind of leverage this for new advisors that are joining or the partner firms that are joining. But we have every intention of doing that because we think there's tremendous value there, and we want to help you grow. Our entire ethos is break away, go where you grow, and clients, if you aren't experiencing this already, clients don't have a whole bunch of CPAs that are knocking on their doors to try to let them do their tax return. You can't even find CPAs that have space to be able to do a client's tax return. So what ends up happening is the client's asking you, well, you know anybody that can do my taxes? And you're going, not really, I don't know. And so here you are, you're already doing a tremendous level of work for the client because they're having to figure out their own tax situation. They're asking you for advice on all these things. You should be getting paid for that. And you should find a way to get paid for this tax advice that you should be want to give to these clients. And this is the way to do that. Have a certified CPA giving them the advice for their taxes, and then you charge the client for that. And the client gladly pays it, right? Because the value that they're getting from it saves them so much money in taxes that they're kind of like, is this all I'm being charged for? I mean, I'll pay you more because I can actually talk to the CPA. Are you telling me that I can actually have a conversation? I don't just drop my stuff off at the reception desk.
Yeah.
I can actually talk to the CPA. I can get ongoing advice from the person doing my taxes.
And imagine how powerful that is too, as far as just throughout the year. It's like the analogy we use of, like the tax return that what you're typically getting is you're just getting somebody that does a report card, but what you really need is somebody to help you with the homework throughout the year, so that when the report card comes back, it's an A+, right? Like that's what you should be wanting and desiring. And just think about for a second just how sticky that business is, right? It's like the analogy that we draw where we're just like, it's like, imagine if you're offering this to your clients as just part of what you do, and they're taking you up on it, which most of them will, and you create this durable business, and then, they get some financial advisor knocks on their door, figuratively speaking, or maybe literally speaking, and says, hey, I want you to, do business with me. Think about the difficulty in making that change for them at that point, right? I mean, like something has to have gone very wrong for them.
They'd have to fire their CPA and their advisor.
Their advisor, right? It's kind of like,
and you can't even find a new CPA.
Yeah, and they can't even find a new CPA in a lot of cases, and they're not going to like the fact that it's not holistic and together. Okay, and so at the end of the day, it's like you're, and so then guess what that does? Guess what that does to the value of your business, right? The equity in your business. It makes your value of your business higher, okay? Because why? If you're buying that business, you're thinking
It's more valuable.
it's stickier,
If
right?
if it's stickier,
it's stickier.
if I'm
you know?
buying a book of business and I know that they're also getting their tax return done by my firm
Mm-hmm.
or this firm that I'm buying into,
Yeah.
that gives me a lot of reassurances that this person isn't just going to go and
Yeah.
move their money somewhere else.
Exactly. Yeah.
And so I'm willing to pay a premium for that.
Exactly. Yeah. So imagine if you could have all of that and then just have it be like easy button, like we'll help you make that a reality. That's what Uptick Partners is all about, right? That's what we're all about. It's helping people grow and helping people and doing a better job for the end client, right? And doing a better job for the end client and delivering holistic planning and holistic advice to clients at the end of the day and helping advisors to be able to do that. Like that's part of our value proposition as well, is bringing that to people. So it's just the tax business is so exciting. It's like probably one of the things that is one of the key reasons that we broke away. It was this idea that there has to be a better way and that we shouldn't be in this position where we feel like, well, if we give tax advice, then we could be terminated for this and lose our job. And the reality is that, so many financial advisors out there, just their default answer is, well, that's just, you need to talk to your CPA about that. That's something I can't really talk to you about because that's tax advice, and it's like, yeah, but the problem is that if their CPA in many cases is not doing it, then the client ends up, who loses in that situation? The client loses. And that's what we're set out to fix that. And so
so the tax advice is coming from a CPA,
mm-hmm.
right?
Yeah.
Tax planning is coming from the financial advisor in most cases.
Yeah.
But it's a very important distinction, and that's why you need a CPA.
Mm-hmm.
That's why you don't just do this.
Yeah, you want it to be legit.
Yeah,
and
it needs to be.
Yeah, well, and if you're going to actually do the return,
right?
Okay, if you're going to do the return, then you've got to be either a CPA or an enrolled agent or something. I can't remember if there's a third option, but yeah, CPA or enrolled agent, I think. So, so that's a part of the value proposition that we intend to add, again, as an optional service, right? Optional in that hey, some advisors that join Uptick are going to want that. We expect many will, but it's not something that you have to have,
right.
Okay? And so we're pricing our business model in that way. So I think ultimately when you go back to this whole idea of payouts and all things payouts, I think the main thing to take away about what we're striving for here is to offer people what we think they really want and what we would have wanted, which is do the things that I have to have really, really well and charge me a fair price for that, and then make other services available that I probably would want, but make them optional and also make them very cost effective. And then last, design the entire system and the entire payout structure in a way that is very easy to understand and very transparent, so that we don't feel like we're being nickeled and dimed, right?
And built for me.
If we had that, then that's I think what we've said many times is that we would have done that. If that existed, then we would have done that. And but it just didn't, and that's okay. And so somebody had to plow that ground, and it just turns out that we're the ones to do it. So we're super fired up about it, and we expect the growth to be transformational. So.